Hi, everyone, and thanks for joining us today. I'm going to be talking in this session about Asian trade shocks and flows, just to have a look at some of the key changes that have happened and are currently happening and will be happening in the next year or so. There's a huge amount of happenings in the market, lots of expectations, lots of rumors, lots of changes in policy. So I've just picked out four themes which we can look at briefly, and we can hopefully discuss those in a little bit more detail in the Q&A session later. I'm going to kick off with scrap markets. Obviously, the big change at the start of this year is China's liberalization of scrap import markets. Underlying this is really the fact that Chinese scrap markets could use imports. If you look at China's goals, this chart here is taken from the targets from the 14th five-year plan and from the draft guidance for the steel industry on the five-year plan. And you can see there's obviously a big story around reducing third-party iron ore imports, but also part of that is a rapid increase in the consumption of scrap, around an additional 100 million tons a year of scrap supply by 2025 relative to 2020. Now, a lot of that, in fact, most of it will come from domestic supply, but because planned economies are not perfect and developments happen at different speeds, actually China's ability to consume scrap is increasing faster than scrap supply itself. And so imports are a useful way for China to accelerate the use of scrap, support the development of scrap consumption in China ahead of growing domestic scrap supply. So there's a value to the Chinese steel industry in importing more scrap. And the key thing behind that is here in that third paragraph on the screen, which is EAF capacity is expected to reach around 250 million tons a year by 2025. That is up from around 160 million tons a year. And BOF scrap rates are also going to increase to around 21% from 16% in 2021. So that's going to mean higher demand for scrap, and achieving that high rate of scrap use smoothly will be aided by higher import volumes. Now, there's a bit of a complication around that, which is that the new import standards, they do mean the end of the what was effectively a ban on imports that existed until the end of last year. But there's an additional factor. It's really moving the goalposts rather than completely opening up the market. The new standards for heavy scrap only allow non-ferrous metal impurities of up to 0.3%. So there's a problem with importing HMS 1 and 2 into China. This is obviously an issue for the commodity scrap market internationally. HMS 1 and 2, these are the grades that really provide the mass of international commodity scrap trade. And those are the products that can't go into China. So China so far has been ordering primarily Japanese H2 and HS grades, but it's also been buying some P&S from the US, even from the UK, and from other suppliers as well. And also there's some shredded coming in. But the inability to purchase HMS is obviously limiting its sources of supply. So if you look at what impact this has had on prices, the opening up of China's scrap market has meant that international and Chinese scrap prices have begun to converge. So in this graph, we have Chinese domestic heavy scrap, which is a price that we added this year. You can see that on our price analyzer now. And then HMS 1 and 2 8020 CFR Turkey, but then adjusted for Chinese taxes so that they're directly comparable. And you can see that the prices veered apart through 2019, 2020, when the scrap trade was artificially closed down. And from 2021, they've moved much more closely together. But that match is also still not perfect. And one of the reasons for that is the problem with China not being able to import HMS scrap. Because China is really importing premium scrap, there's still a slight disconnect in between those two markets. And if you look at scrap markets outside of China, then in fact, there's a huge demand for premium scrap grades globally. And in fact, if you look at premiums for either shredded scrap or manufacturing scrap relative to heavy demolition scrap, those premiums are actually increasing in Europe, they're increasing in the USA. And so that's making that market very tight. And so as a result of that, even though this is a trade flow which has changed fundamentally in its nature, in that scrap imports to China are now allowed, the volumes have actually been more limited than expected. Now, if you look towards the end of that chart, you will see a slight gap in price opening up, and that has led to increases in bookings. And imported scrap volumes into China are increasing a little bit last month, a bit more this month. And going into May, they're becoming a little bit more regular in terms of the volume that's coming in, but still focused on those premium grades. I'm going to move on to the second trade issue. One of the big dramas for this year, there's a will they, won't they question over whether China will change its export rebates. This has been based primarily on rumors for most of the year, but they're increasingly confirmed by a wide variety of sources, and yet they have not happened. So going back to the start of the year, rumors began to be circulated more widely that there was going to be a cancellation of China's export VAT rebates. So in other words, the 13% VAT that is charged on domestic sales would be rebated to exporters. Would no longer be rebated to exporters. Currently, most steel products receive a full 13% rebate. In March, there was some more fuel added to the fire in the 14th five-year plan. When it was published, it contained this phrase, optimize the quality and structure of export commodities. And for those of you with a long memory, that harks back to a previous generation of export rebate policies back in the day when there was a gradation of tax rates depending on how processed the product was. So semi-finished exports received no export rebate and had an additional export tax. Hot rolled products received no export rebate, but did not have an export tax, and cold rolled and alloy steel products received different levels of rebate. And the idea, of course, was to push exporters into exporting higher value added products rather than low value added products. And so this generated and complicated a whole range of rumors over whether the full rebate would be cancelled or whether the rebate would be cancelled for some products and only reduced partially for other products. The bottom line is that really nobody knows actually what the new policy will be, although there is a prevailing understanding that at least for hot rolled products now, there will be no rebate in the future. But the reason we don't know is that these rumors suggested that a tax change would be effective the 1st of April. 1st of April came and nothing happened, and the rumors shifted, and they said that the change would happen on the 10th of April. The 10th of April came and nothing happened. So at the moment, we still do not have any official change in the tax policy. But people are still saying that it will be happening. The sources who are saying this are well placed. They've been briefed by senior officials that it will be happening. The expectations of mills are that they will be losing that tax rebate, and they've been changing the clauses that they're using in their trading contracts in order to cover the risk, or at least define the risk and how it's shared between them and their counterparties. So the expectations now are probably by the end of the month or at the end of the month, there will be a new policy. So what this means for markets will depend partly on which specific market you're looking at. If you look at what has happened so far, in fact, the most obvious change you can see is if you look at March export data, exports of both long products and flat products increased quite sharply in March. This was really because exporters were rushing through cargoes that were going to be shipped anyway in April or later, and trying to ship as many as possible in March so that they could avoid any complications over the tax change. In the end, of course, it didn't happen, but in March, they didn't know it wasn't going to happen. You can see both longs and flat products seeing some impact there, but because of the balance of trade and because most long products are in fact slightly less competitive out of China currently, hot rolled coil and some of its downstream products are more competitive. coming out of China into Southeast Asia and some other markets. Because those are the more competitive products, they have more to lose in a sense. So once this rebate is lost, it's likely that the main impact in terms of export volumes is going to be on flat products, slightly also on long products, but the big change is more likely to be on flat products. For long products, you might actually see something a little bit different. Exports have already become largely priced out of the market. If you look at long product export volumes over the last few months, the volumes are really being sustained by a fairly strong trade into South America, and a lot of other markets have been shrinking. So the impact may be slightly less in terms of exports, but you will also then have a secondary impact on semi-finished imports into China. If you look at what's coming in, it's primarily been billet, and a lot of that has been driven by the expectations that production in Tangshan would be shut down, and some of that has been compensated for by importing billet for re-rollers. But of course, if you shut down any long product exports, then you do have a situation where the mills that were producing products for exports may be shifting more material into the domestic market in any case. And so that could reduce the incentive to buy billet imports. Moving on to the third issue that I wanted to look at, the relationship between capacity growth and trade flows. I wanted to just point out a few trends here in Southeast Asia, which is really the area where capacity changes are perhaps the most dramatic in Asia currently, perhaps excluding India. But I would say even including India, it's a much more significant trend for most of Asia. On this slide, what we have is blast furnace activity data. This is a new set of data which we are starting to publish, and this will be available in our new Southeast Asian product, which you will hear more about elsewhere in the conference. And what this data is essentially it's satellite data. It tracks the heat activity for blast furnaces and the related equipment, and it gives a sense of how active those blast furnaces are. It allows you to see, for example, in within a week, you can fairly easily see new blast furnace starts. You can see maintenance periods and so on. And so this is for a range of blast furnaces that we track. And what it shows really is that overall pig iron output, this is through 2020, it's a fairly steady increase through the year. And I think earlier this morning, we heard Mr. Yo from CAZ say that, even though last year with COVID, Southeast Asian steel demand fell year on year, but actually Southeast Asian steel production is higher year on year. And this is really part of the same trend. The reason it's higher year on year is that you have a fairly steady commissioning of new capacity. And over the last year, for example, we've seen Deshin bring on a significant amount of capacity in Indonesia, and we've seen Hoa Phat's Dung Trat plant in Vietnam bring on an additional 2 blast furnaces over the last 12 months. And so that means that it's inevitable that steel production is going to be higher. So in terms of trade flows, I wanted to bring out 2 trade flows which have most obviously already been impacted, and 2 trade flows that maybe have still to be impacted, but are likely to see some impact in the next couple of years. So firstly, examples of what has already happened here. Firstly, Malaysian billet and wire rod exports. You can see a very clear increase from 2019. Really, the commissioning of Alliance Steel, put Malaysia into a position of being a prime billet and long product exporter in the region. And so there was a large increase in trade flow there. And then Indonesia, slightly earlier, with stainless steel, with led by the investments of Tsingshan Group, but also now joined by a number of other companies, Delong Holdings, for example. Stainless steel exports increased very suddenly with the Tsingshan commissioning, but also have increased fairly steadily since then as more companies have joined them. So what might still be coming? Well, we saw in the blast furnace data that Hoa Phat Dung Trat is ramping up capacity fairly rapidly. It's began selling its HRC rolling from last year. It's now, a very significant domestic hot roll coil supplier. If you look at Vietnamese non-stainless hot rolled coil imports over the last 2 or 3 years, volumes have actually been fairly steady. And that's really because demand domestically has been growing as capacity has been growing. But as Dung Trak comes up to full capacity, that's another step change in hot rolled coil supply, and that is domestic HRC is given priority over imports because obviously lead times, but also it's competitively priced, especially when we consider freight rates these days. So that growth in capacity is also likely to mean slightly less importing demand from Vietnam. And then the other one is a market that we often, until now, have really overlooked in terms of capacity development. The Philippines has always been a very regular importer of steel, and that's because its capacity has always been well below its own demand. And if you look at Philippine steel imports over the last few years, you can see that really, apart from an obvious dip due to COVID in Q2 last year, imports are really fluctuating fairly steadily around a quite constant level. But it's also a country that's going to see some of the most dramatic change in capacity going forward. So you have domestic steelmakers, Steel Asia is adding blast furnaces, it's adding rebar capacity, wire rod capacity, and H-beam capacity. But then you also have these two large Chinese investments. You have Hebei Iron Steel Group and you have Panhua Group, both investing in large steelworks in the Philippines. Although progress has been fairly slow in the last couple of years, there has been progress made in the last 6 months on those projects. And so the possibility of significant integrated flat steel capacity in the Philippines would be another step change in terms of the steel trade balance for the Philippines. In particular, if you have both of those plants operating at the same time, in order for those plants to achieve the necessary utilizations, they would probably need to export HRC, while Philippine domestic manufacturing began to pick up and catch up. So until demand has caught up with supply, there's likely to be Philippine HRC exports, which again would be a completely new phenomena in terms of Southeast Asian steel trade. Lastly, I just wanted to talk very briefly about two policy directions in terms of trade. Firstly, there's a trend towards opening up, and secondly, there's a trend towards closing down trade. And it's a very open question as to which of these will really win out. And there will be movements in both directions over the next few years. In terms of opening up, obviously, there's significant interest in the Regional Comprehensive Economic Partnership, the RCEP. It was agreed. It's a Southeast Asian project, although China has pushed it as its trade agreement of choice in recent years. But it covers 10 ASEAN countries: China, Japan, South Korea, Australia, and New Zealand. Some of the most significant aspects of it, not only for steel, but in general trade, are the fact that it's really the first free trade agreement that covers China, South Korea, and Japan. And so there's been a lot of focus on that. In terms of steel, that relationship is perhaps primarily weighted towards automotive. In particular, Japanese and Korean automotive parts manufacturers will have freer access into Chinese markets. And so there could be a corresponding impact on steel demand there. In terms of other steel trades, there's actually less of an impact, particularly if you look at Southeast Asia. Southeast Asia and China already have a free trade agreement, and that already gives Southeast Asia producers advantages selling steel into China. And perhaps one of the most important aspects of the RCEP is that India has not joined the RCEP. India was negotiating the RCEP, but it was actually the steel industry in India which said that it did not want to join because it was afraid of higher steel imports into India at a time when, of course, Indian steel capacity is ramping up. In fact, the most immediate impact, considering that India has become a significant exporter of steel into Southeast Asia and into China, the most obvious kind of first stage of impact on India may be putting its exports into the region at a disadvantage. The most obvious example of that is Indian exports into China. India was shipping significant quantities of billet and HRC last year into China. But of course, Indian steel into China still has 2% import taxes, which ASEAN billet producers do not have because of their free trade agreement. So in a sense, the countries that are within RCEP, in terms of steel trade, they may have a limited impact, but it will create a boundary between the members of RCEP and the non-members of RCEP. But that Indian instinct towards protectionism is not an Indian instinct. It's a fairly common instinct. A large number of countries feel this way. A large number of countries have steel industries that they want to protect. And so you see that spreading across a number of other countries. And this is really just bringing out a couple of stories from the last couple of months. So we have, Vietnam, in terms of steel, has, very specifically said that it wants to accelerate the process for placing trade protections in place. Again, under pressure from domestic industries, which see their new plants perhaps threatened by cheap imports from other countries. And we've had some new duties so far this year already, including the duties on Malaysian H-beams, which was set just a couple of weeks ago. India, of course, has a long history of protectionist economic policy, and that continues. There's a lot of rhetoric, but also lobbying by industry associations for protections against imports into India. But there's also some new areas, and one of the ones that I think may be worthy of discussion a little later in the session is scrap as a raw material. Scrap markets have become increasingly important. Southeast Asia is an area which has a large number of EAF producers, and scrap supply has been primarily from Japan and the USA, but there's also growing domestic scrap supply. And so there's a growing pressure on national governments to protect local scrap resources. And we saw perhaps the first example of the year, again, just a few weeks ago, with Malaysia putting a 15% export duty on ferro scrap exports as a way to protect partly its own smelting industry. I'm going to leave it there because I really just want to introduce a few issues that we can discuss later in the session. Please do pull out my points in more detail with your questions, and perhaps also we can add a few other trends in terms of steel and raw materials trade that we can discuss further in the group. Thank you. I look forward to your questions.